Today we wanted to talk about property values and trends for you.
Right, so this is going to be a little bit of a different thing, but we're still talking about property values. We're just looking at it a little bit differently. Most Americans live within 30 miles of where they grew up. This is just a statistical fact. Investments actually follow, if you're an investor, you're going to kind of follow in a similar vein. It's the 90-50 rule for investors typically. 90% of 90% of investment opportunities that people come into are found within 50 miles of our own home. So this means that there's a lot of reasons why. My husband can go into more detail if you want to.
Yes.
But these are basic general facts about where we like and where we like to be. So most people will never leave their area for a reason. But also, can you tell us why an investment property might, just really quickly before we go into more detail?
Exactly. There are factors that we need to mention. First of all, if you're close by in 50 miles radius, you basically have better understanding the market because you're living in that market. Second is the hand-on management. You can manage the property that you are purchasing for your investment. And also third, if something emergency happen, you have a quicker response because you're living nearby. Therefore, these the three main reasons that we wanted to mention here.
Now,
but before we
let me go into a little bit more detail, and then you can do that later. So it's understanding the supply and demand dynamic.
Okay.
We have to really kind of understand the property values, and we talk about that in another video on property values, but trends also have to include employment rates, employment opportunities, population growth, future developments in the area, because who is going to know that they're planning a whole new development other than the person driving by on the street? So understanding supply and demand really comes into play when we're talking about things. So I want to kind of really deep dive into that supply and demand. Now, let's do our introduction. Let's hit it. Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below.
Now, what is important now that we wanted to mention, and you might have heard it, if you're a professional investor, you're pro, you know this.
Or you're thinking about it, or you're
thinking about it. These things that is important we wanted to mention. The first thing is the cap rate for the investor, which they call it also capitalization rate. And the second thing that also is important, either residential or commercial, is cash on cash return to basically evaluate the potential property values and profitability for the investors.
So what is the cap rate?
The cap rate actually is the rate of the net operating income to property asset value. But net operating income is the amount that you put the money and out all of your expenses. Therefore, that is a net operating. That's why we call it net operating income.
Now, cash on cash return is a little bit different, but everybody cares about it. This basically is how much money did you put down and how much is that property going to earn, either with your appreciation, your ownership of it, or your investment of it. So if you're a buyer and you're putting, I'm going to make up numbers right now, $20,000 down on a $200,000 house, 10% down, and then over time you're paying double. You're getting a lot of appreciation, a lot of that factor back. Now, if you're putting $20,000 down and you're just paying the bare minimum in a 30-year mortgage, it's a slower rate on return, but you're still getting the property value and the appreciation of it. Now, if you're an investor, this matters a lot. Why? Because I put $20,000 down on a $200,000 home. I'm getting, do the math for me. If I put $20,000 down and I'm getting $2,000 a month in rent, what's my cash on cash return rate?
10%.
Right, because it's $2,000 divided by my $20,000 I tossed down, and so I'm getting a significant cash on cash return.
Exactly. Therefore,
and 10 is good.
Now, we wanted to talk after the cap rate and cash on cash return, we wanted to talk about in-depth market analysis, or CMA, which basically is another tool for the investor to evaluate the property value.
Anybody. And buyers, sellers, we're going to run a CMA for you. This is a CMA.
Exactly.
We're going to run a CMA for you. And of course, we just want to, again, remind you that there are differences. Size, age, amenities, those things really do matter. So if you're looking, you have to look at the other 1,800 square feet homes, not the 4,000 square foot home, because that's going to get a different price than that 1,800 square foot home. So you have to take those things into consideration. Also, if your home is new and that 4,000 square foot home is older, that's going to play in a factor too in a different way.
Exactly. Therefore,
you can do the key indicator. So
now we wanted to talk about role of economic indicators. Basically, beside of this market analysis that we did, they are some of the things that it needs to be incorporated also with the property value. One of them is the consumer price index, or the CPI, and unemployment rate or mortgage interest rate, or at the time of that you wanted to be investing or buying or selling, is the rental vacancy rate for that area. These basically give you the vision to incorporate all of the factors that are important for the property value.
Now, I want to just quickly add, anybody who's paying attention to market, we're filming this in February. I don't know when we're going to release, but we're definitely filming in February. And at the filming of this video, interest rates shifted dramatically based on CPI and data that came out with CPI. So just really, that data can affect the stock market, it can affect the mortgage market, and it can affect us when we're looking to buy and sell homes as investors, home buyers, home sellers, because all of those things really do matter, even though you don't think it matters to you. It does matter.
Exactly. Now, the next thing that we wanted to talk is really leveraging technology and data analytics at the time of this video, 2024. And we don't know when you're going to watch it. Lots of AI is in the market and is transforming the market. And definitely this using the big data analytics to forecast the property trend and value, and also GIS, that many places they offer that, which is really is geographic information system, definitely give you an idea to analyze the spatial data to identify the growth patterns of the property in the location that you are looking for the property.
And the last thing we're going to mention in this video is, of course, micro factors. So again, this is why 90% of investors stick to their area. 30% of us, a lot of Americans just stay 30 miles from our home, because you understand your market. You know your neighborhoods. You know those local areas. You know the streets. You know cities. Crime rates. You know school zones. You know local loaning laws. You know festivities. All of this can affect your attractiveness to home buying, home selling, investing into rental properties as well, because sometimes laws can change. So if there's a law making it a little harder for Airbnb, which is happening in other parts of the country, that's going to affect the investment portfolio of other people. But it might affect home buyers in a different way. So all these micro factors, local zoning laws really do matter. So you want to sometimes you know those things before the big picture does.
Exactly. And don't forget to call us at 252-327-3357. We are local real estate agent in Greenville and Winterville, North Carolina, and we love to help you.